Good morning, folks. Welcome back. Hope you're all doing well. For the folks in Telegram, I'm going to start off by doing a little housekeeping here. I got a lot of comments sent to me asking me for the ongoing commentary or any kind of charts or whatnot to post that through X or what was formerly known as Twitter. And the reason why it's better on Twitter, and I agree in this regard, is because X or Twitter allows you to translate, and Telegram doesn't easily do that. I think there are things out there that help do that, but it's so cumbersome and so much of a challenge for me as the content creator to help facilitate that need from everyone all around the world. So it's much easier for me to just post my commentary. If it's live and I'm not doing a live stream, it's better for me to just post it right on X. So that way everyone that's following me on X, they can hit the little translate function that X so graciously allows for. The posts that I make in the Telegram are primarily focused just on the PDF and the notes. Okay. Um, I have been distracted with preparing for a road trip and getting my house ready for my oldest to take care of my little ones, my pups, while we're gone. And that's it's causing me to, have a lapse in focus and concentration. So that's the reason why you haven't got anything. But yesterday I did some live posting on X, so that way you can get all your screenshots and such from that. That would be like the consolation prize for those that were waiting for things that appear in Telegram. These charts will appear in Telegram shortly after it posts on YouTube this morning, and then tonight I'll do another roundup of what the market did today. No live commentary on X. Like I said, I have lots of things I have to take care of before I head out. So anyway, let's get this ball rolling here. Appreciate the patience while I get through that bit of business. And a lot of you know I like to go and run your mouth about how I don't get right to the point. I talk too much. If I don't talk enough, you won't learn. So this is the focus on Forex portion of it, where we look at the usual suspects: dollar, euro dollar, and cable pound dollar. All right, I'm going to go through this rather briefly, so that way we can get through it. Left-hand side, as always, dollar chart is the daily, and the right-hand dollar chart is the 5-minute chart. So I have the buy side and bounce sell side efficiency annotated in here, and the last 3 days have been pretty much a nothing burger. We had a little bit of a run in here, and I'll explain why that took place. And before I go any further, now on that remark, uh, hopefully I've earned for the new viewers that don't know me. When I talk about things in retrospect, or if I look at it in teaching means of communicating, this is why price reacted this way, and it's in hindsight. I'm the one that went out there this week and told you the very low of the day on NQ, like right as it was happening. I gave you every level and everything. So, and told you it's going to go to an all-time high. Hint, hint, nudge, nudge. So anyway, I've earned it. And if you don't believe that, if you don't agree, then move along, because I don't have time for people like that. You're either lukewarm and we spit you out, or you're on fire and you want to learn here. That's how it works. So the last 3 days, it's been pretty much nothing except for this little price run in here. And you can see that we traded down into consequent encroachment, which is the midpoint of this buy side and balance, sell side efficiency, fair value gap. Okay. And we dug deeper into this order block, which is a daily chart, PD array. But I want to bring some more things into focus. I want to show you, by grading the inefficiency of this buy side and balance, sell side efficiency, you can see it came right down into lower quadrant. You see that? That comes in at 9752.6, right in here. Okay. And then we had that rally that took out relative equal highs and buy side. Continuing on, if you use the discount wick here, like a gap, and we grade those as well, you can see that we came down to that also. And here is where you blend both of those concepts together. The inefficiency of the daily fair value gap is in and of itself wonderful. But if you have a wick like this, okay, that goes and travels towards the lower end, either touches it or maybe even go just below it a little bit outside the range, which is permissible because the wicks are allowed to do the damage and the bodies will keep the narrative underway. That way you'll follow the narrative of price action more accurately if you follow just the bodies printing, and the wicks are just, the worst case scenario, your stop gets tagged, or the best case scenario, you take someone else's stop and enter there. Okay, so that's the story behind a wick, the legend of the wick. The discount wick on this one here. Why am I picking this one? Why am I not talking about this one? Why am I not talking about that one? Because this one is the most elongated to the downside. It means it's the longest one, and it also meets the criteria of trading back to the low of this bullish fair value gap. So there's a rhyme and reason as to why I pick certain candlesticks. It's not willy nilly. I'm not cherry picking. Okay, but if you do that in concert with the buy side and balance, sell side efficiency fair value gap, you get perfection, baby. Don't believe me? Look at your dollar chart and you'll see that the low of that tick right there is exactly 97,522, which is the lower quadrant of that discount wick. It turned on a dime and then rallied, consolidated around the consequent encroachment of the fair value gap from the daily chart, rallied up. And where to go up into here? This is a mystery, right? Mysteries. Call Scooby-Doo and the gang. Okay, well, here you go. You have the sell side of balance, buy side of efficiency, right? Yes, but more specifically, it's a suspension block. I already see people out there sharing things with me and other people already. They're talking about, here, look at this move here I did with the suspension block. And they're anchoring to a candlestick that has absolutely nothing to do with a suspension block. Okay. The candle has to have a volume imbalance at the high end of it, and it has to have a volume imbalance at the low end of it. And we annotate the volume balance low to volume balance high. We do not use the wicks in between. Then, if you do that, just by the volume balance high and the volume balance low, you're getting the suspension block, the range. And you can grade that. And if there's an inefficiency between the two wicks, clearly you can use that. But for suspension block annotations and for that narrative, we're using the principles I'm showing you here. That's my ICT suspension block. If anybody's showing you examples where the candlestick they're anchored to doesn't have a volume imbalance on both sides and they're not anchored on the lowest of the volume imbalance on the low end and the highest portion of the volume imbalance on the high end, it is not being annotated correctly and they are talking out their rear end. Okay. I understand y'all want to run out there and start using something you don't even know. Okay. Just like when I was teaching martial arts or I show a magic trick to somebody, they automatically want to go out and think they can do it themselves and they end up hurting themselves or they hurt their pride. So just settle down because you haven't learned anything about it yet. I just introduced it. But this is a suspension block. It's a premium PD array because price was down here and rallied up. Down from where? Lower quadrant of the discount wick on the daily chart here up into this range. So if this suspension block is graded, you can see getting up into the upper quadrant, that's this right here. So we wick up into it and then we drop back down and we go into no man's land where there's no reason for price to be traded to in between inefficiency by the suspension block on the daily chart and the fair value gap on the daily chart. And that was the rhyme and reason as to why it did what it did here. Now, obviously, you would expect when we go over to euro dollar and cable, there's going to be a short, which would be a mirror image of all this business down here. And as you would see here, we have a sell side balance, buy side efficiency on the euro dollar daily chart on the left. The market rallies up here a couple days ago. And when it trades up into this 5-minute chart, okay, it trades to 1.1755. It's in the bottom area of this sell side balance, buy side efficiency. Okay. This grading in here affords us this look right there on Wednesday's trading. That's this rally up here. Now, I anchored a fib from the high down to that low. So this is point A, point B. If you use a Standard deviation on your fib of positive 2, you'll get 1.16892. That's point C. Okay, that's a swing projection. I teach this in the 2016, 2017 paid mentorship content that I've uploaded for free. You can find the playlists on my YouTube channel, Inner Circle Trader. And we also have the bodies pretty much nailing that. And the errant price action is afforded to us by seeing this drop down into September 11th, 2025's daily discount wick upper quadrant. That's this candle here. That's September 11th's discount wick. The purple line right there, that's the upper quadrant at 1.16861. And that's what you're seeing here. That's what's being delivered there. And then we had that reaction up into the old order flow. So from this jump street, we dropped down. This fib was in my way. That would have been otherwise a breakaway gap annotated there. We have inversion fair value gap, a closed candlestick right there. And we went below it, came back up, stayed in the lower half, which is ideal, inside of a small little bearish fair value gap as well, sells off, breaks the low, and we have all this redelivery back and forth with these wicks back and forth. So this discount wick, we grade that. So when price is below it, it's going to act as a premium array. It stops right here after wicking through it, but it stops right here at the consequent encroachment. But the bodies, look at the bodies. See, it's telling you the narrative. It's staying in the lower half of this discount wick that's going to act as a premium array. But more specifically, the bodies are staying at the lower quadrant. That is indicative of strength or weakness. Weakness. And the market falls out of bed. One more time, the body's respecting the low of that wick. Breaks lower. Order block, mean threshold hits it beautifully. And then we have the market trade down into the targets I've given you here. Moving on into pound dollar. This one's very similar. We had an old inefficiency up here, creating the premium wick there. Price trades up in the consequent encroachment of that premium wick right there. So point A, point B, point C. If dollar's going to go higher, then we're going to be looking for the opposite in cable and fiber. And cable is pound dollar, fiber is euro dollar. The market drops down, breakaway gap, institutional order flow entry drill, which is just entering an old inefficiency just by a little bit, by one fraction, maybe one or two ticks above the framework that would constitute a bearish fair value gap. And then we drop lower. We have an inversion fair value gap there. And we also have a premium wick that's graded here. So look how it's staying in the lower quadrant of that, respecting the halfway point of that wick. And its inversion fair value gap, it's staying at the consequent encroachment of that dotted line. So the market breaks lower. You want to look at this area in here on your own charts. We break lower, crane all the way down into point C, and that comes in at this premium wick. Now, why am I picking this one? Why can't I use this one? Well, you could have when price was starting to drop down. You would be using that. But also, if it keeps dropping lower, this area here, it's below what would be in this candlestick, right? So you'd be referring back to that same range as well because it's treated just like a gap. So you grade that as well. And price trades down to the lower quadrant beautifully. And it agrees with the swing projection down here. So just a really nice little drop here for cable. Otherwise, this week in Forex has been pretty much a nothing burger. I mean, to me, this is the only thing that's been noteworthy. All right. We are in focusing on index futures, and the usual suspect is the Christmas mini NASDAQ futures contract. All right. Daily chart left-hand side. This premium wick, that's what's being highlighted with these gradient levels here with the fib, and you can see that down here. I started the live stream on YouTube. I talked about all these things live. So everything I'm going to talk about here, except for the PM session, because I wasn't with you in the PM session. Everything in the morning session, I gave you live as it was happening, explaining it, talking to you. Actually, I said YouTube, didn't I? I meant to say X. I was posting things on X. So I just made a mistake there. The intermediate term sell side liquidity pool is underneath this low and below the gradient level of this. And it's anchored to the order block that's here. There's a huge down close series of candlesticks that is a bullish order block and change in the state of delivery. So that price is the open, you extend that forward. That's what this blue line is over here. That's the bullish order block. Okay. So we trade down into the gradient levels of that premium wick on the daily chart. And you can see how it's being respected there and then rallied up. Now, what caused this? Now, I'm going to say something, and I know some of you people just simply won't believe this, okay? But I was literally minutes away from going on X and posting that if you're long, you want to be taking that off now and prepare for Thursday's effect, where the market tends to have, well, when it's been going up, it likes to create these false highs and it can start to pull back. So the government shut down right now in the US. And as far as I'm concerned, they haven't been working for decades, so they should get their pay held as well. But the point is, it drops precipitously. And I wish I would have had the time to get on X and do this because then I would have really looked like a rock star. But it is what it is. Just take my word for it. I was going to do it, but I didn't find my way to get to X in time to post it. And it moved too fast for me to mention it in this area here because it just was too quick in dropping. Trades down into the order block, and then we started meandering around in here. So we'll go into the 1 minute charts, and these will look familiar because this is what I was posting on X. Okay. And here's the regular trading hours opening price that starts the opening range high. And why is that the high? It's because we closed previous day's regular trading hours here at this price. And you can see the annotation there. And this is a full gap closure. And the intermediate term sell side liquidity was never taken. So that is bullish or bearish? Bullish. And then we meandered up back into this sell side imbalance, buy side efficiency. And I'm certain that some of you wanted to know why I annotated that one. Why did I annotate this particular sell side imbalance, buy side efficiency, and labeled it an inversion fair value gap and say not this one? Okay. Well, it's because we had the straight run right from the opening down to here. We created a short-term low, and then we rally back up into this gap. So that's a fair value gap that's bearish, and then it sells off again and creates a lower low. Whenever you see market structure create a low with a lower low, if there's an imbalance in there, there's a huge probability that's going to become an inversion fair value gap. It doesn't mean it's going to happen immediately, but it means that you need to be aware of that one because there's a structural run on liquidity where it drops, comes back a little bit, and runs a lower low. Anyone that was trying to catch a low here or a bottom, they get slaughtered. But that inefficiency, that run down there, is going to behave many times in the future as a inversion fair value gap. In the book, I'll give you more details. I don't want to give everything out here right now because everybody's literally taking notes right now and they're just throwing AI books together and putting them on Amazon. And it's just, I think it's cute that they're all trying to, talk like they and pretend they know what I'm talking about. They don't. Okay. But their book sales are going to suffer soon. But the market uses this range here after it hits the full complete gap closure, comes back up to consequent encroachment of it, full gap closure, and then drops down into an order block here. And I said, this is where we're at, the line in the sand where either we run for intermediate term buy side, and if it's going to go there, what's resting above that? First presented fair value gap. Okay, and on X, I mentioned that some of you may look at this one here and call that first presented fair value gap. It is a fair value gap, but when I like to look for the specifics around trading with the narrative of first presented fair value gap, I want to look for the first one that has the very clear distinction between something like that, which is very small. It's only like a tick, a couple ticks rather, handful of ticks, and then you have a couple handles here. That's much more prominent. It's much more obvious. It's a more visual displacement in price action versus small little tiny separations, which is a common gap. This is not a common gap. This is first presented displacement by definition, first presented fair value gap. Okay. So why is this intermediate term buy side? Because it's the buy side above this whole bit of business retracing higher and then went and made a lower low, closing the entire opening range gap. So the liquidity that's resting above these relative equal highs That's intermediate term. These are minor because it's inside this price leg that made the lower low at closing that opening range gap. So it's all structure related in terms of classifying market structure, highs, lows, intermediate term highs, intermediate term lows, short term highs, short term lows. It's that kind of thing. I teach this also in the paid mentorship playlists. Go on the 2016, 2017 playlists and look for the individual videos, and you'll see things being taught about market structure. So minor buy side, that's going to be drawn, but it goes right back up to regular trading hours, consequent encroachment, then back down into this sell side imbalance, buy side efficiency. That's going to act as a inversion fair value gap. We have a wick that drops down in here. We'll get into what that is and why it did this, and also that one. But it's trading essentially around the consequent encroachment of that old sell side imbalance, buy side efficiency, which is bearish usually when price is below it and comes up to it. But we labeled it, I labeled it rather, and told you it's going to act as inversion and take us up into first percent fair value gap. I stated back here where it was line in the sand where it could go either way, and I told you the side I thought it was going to go. Okay, so for the trolls that like to take things out of context, take little sound bites and share it amongst their circle jerks, I did say I wanted to go up, take the intermediate term buy side, and go to first percent fair value gap. And then I took my break for lunch. The market uses this inefficiency, those levels, and projecting that through price action. You can see how we hit the low. Let's close that candlestick. Rallied up. SIBI later turns inversion fair value gap that's bullish. Drops back down to lower quadrant of this candlestick's premium wick. Upper quadrant starts to rally. We drop down into regular trading hours, lower quadrant, and the high of that candlestick's premium wick. That's what this was doing. And it was also just coloring outside. After I mentioned publicly this is going to be an inversion fair value gap, you know, the boys up there in CME, just a little coloring outside the lines, trip you up, but the bodies are doing what? Staying above the upper quadrant. See that? This line here, the gray line, this line here, that's grading this inefficiency. So you can see the bodies are telling you, what's it want to do? It doesn't want to go lower. It's indicating that it's not wanting to go lower. Why? Because the narrative is being displayed in the bodies of the candlesticks. Okay. And now we're looking at this premium wick. Okay. So these levels here are now being shown here, and you can still see the lower quadrant of that one. So either one, if you were to use this one or this one, why this one and not this one? Look at the highs on your chart. This one's lower than this one. So this is the higher candlestick premium wick. Market drops down perfectly to the tick to lower quadrant if you're using that one. So you can see my concept still works. When you're grading premium wicks and discount wicks from the daily chart, or any time frame for that matter, because it's not universally limited to just daily chart only. It's every time frame. And by having these on your chart, it's like a spider web. You're going to catch a fly. You're going to, but you have to use other things in concert with it. Like there's a fair value gap right here and a bullish inversion fair value gap there. Or look at that as venom at the lower quadrant of that premium wick. You see how many times I can build the model right in front of you just by a small little sample set of things. And notice how my things are agree, whereas retail logic, you're not going to get a Bollinger Band. You're not going to get a stochastic divergence. You're not going to get a MACD crossover. You're not going to get willy-nilly Ichimoku. They're not all going to agree. Pitchforks aren't going to agree with all that stuff at the same time. Elliott Wave ain't going to agree with it all the time. Supply and demand ain't going to always agree with it. Wyckoff isn't going to agree with it. So that's the problem with retail. See, my stuff fits together like perfect puzzle pieces, and none of them are isolated. They all agree on the same thing. It's building blocks that's going to lead us back to the promised land of that first presented fair value gap above intermediate term buy side liquidity, as I called for on X live in front of you, real time, before it happened. And you can see all the building blocks leading up into. Now you get the little errant price action down here. That's this one over here. It just colors outside the line just a little bit, but it's reaching into the regular trading hours, lower quadrant, the opening range gap. And the high of that premium wick. And just outside of the inversion fair value gap I called for. So anyone watching that, they probably were tickled. They're like, ICT's wrong. I can't wait to tweet to him and say, you did it wrong. It doesn't work. But it worked though, didn't it? Because it fits things I teach. The wicks are allowed to color outside that. It's absolutely permissible. But when it is full on a bold down close candle, it looks scary. It's terrifying if you're in there looking for something to go long, or if you're long and you rolled your stop loss just below the inversion fair value gap. Never, never, never do that until it breaks structure, leaving it. What would that look like? We have all these little short-term highs in here. We have the market dropping down from this high down to that low in here. When we left the inversion fair value gap, there's nothing taking out that short-term high yet. It does so there. Then if you're long from down here, then you can roll your stop loss below intermediate term or inversion fair value gaps. You're trailing it with intermediate term market structure swing points. And I cover a lot of that stuff in the books. You'll see stop loss placement stuff in the books. There's literally several chapters where I'll talk about it. But the buy side balance, sell side efficiency here, fair value gap, we trade to the upper quadrant of that. It rallies up. Here's a measuring gap. Another I don't think I have enough space in here to annotate that bullish um, inefficiency. It trades down into that as well, rallies up. And then we have a suspension block, bullish. The volume bounce to the top and bottom. Note that on your own chart. Same thing here, bullish suspension block, but volume bounce above and below. And whenever we see this, it doesn't matter if there's a wick that came above and closed over top of that range that creates the suspension block. I will still use that. Suspension blocks are isolated candlesticks that really represent a point at which the algorithm will come back into it. Okay. And I'll teach what that is at a later time that's causing it. But for right now, just get used to seeing them on my charts as I present them. We have minor sell side liquidity, relative equal lows here after reaching up into the first percent fair value gap that I shared with you as it happened. So random. And if you watched it live, it was real quick. It was down here, and all of a sudden it just ram. It just in one tick, it did this whole run right here, which was wild. Very, very satisfying as an ICT mentor. The man. So we dropped down into the bullish suspension block here and that old intermediate term buy side liquidity pool. That's what's happening here. And then we rip up into it one more time, trade into the upper quadrant of the opening range gap. So 2 times it hits it here, and that's pretty much the business for NQ. I had a lot of fun sharing yesterday on X. I had some people I had to broom, literally denying what I was showing real time as it was happening to the tick. And like I said, I have no time for you if you're doing that stuff. If other people are talking about me, whatever, let them talk about me. Just keep score. Okay, I promise you. I don't need to talk about them. I don't need to talk about them. I don't need to talk about what they can't do, what they've never been able to do, what they can't prove. I don't need to do all that stuff. Just watch them. You will know me and them by my fruit and their fruit. Period. I don't need to be out here to be toxic. Okay. I can have fun with y'all, and nobody needs to be beat up by me. Okay. And nobody's beating me up. So that's the business. All right, folks, that's it for this one. I hope you found it insightful. Thank you for your continued interest. And I will talk to you when I talk to you. Can't promise when that's going to be, but until I talk to you then, wish you good luck and good trading.